I admit, Friday's an anxious day. If you weren't anxious on Friday, you're probably not human.
All this stress that everybody's seeing every day, what it's really telling me is that we have more rate cuts on the way.
These are companies that don't sell products. They're not really impacted by the tariffs.
It is what I consider to be the ultimate sleep well at night REIT.
This company, when there's wars happening, it gets a premium. When it's peaceful times, investors kind of forget about it.
Hi, everyone, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward, with his really fancy shirt. Nick's good to see you today.
Yeah, hey, it's my stress-free shirt. It's a don't worry, be happy type of day. The markets are up. You guys know we record these on Mondays. The markets have already bounced back for Friday. I have no idea what it's going to do between now and Thursday. However, regardless of what the market does, my shirt sends the message loud and clear. I think dividend growth investors, dividend income investors, you don't need to be worried about short-term volatility in the markets. Just focus on what got you here. Focus on your income.
Yeah, nice shirt. Maybe I should wear my pajamas, Nick. That's the ultimate sleep well at night outperform. So maybe in the next week or two, let's both wear our pajamas, and I think maybe we'll get some more views.
Maybe we'll see. We'll see if the tie-dye works. Well, we tie-dyed at my daughter's birthday party about a month ago, and I can pull out. We have leftover supplies, so if I need more tie-dye stuff to get more page views, I'll do what I got to do.
I hear you. Well, no doubt, financial stress is on the rise as Americans are worrying about tariffs and inflation and the weakening jobs outlook. I read an interesting study on Discover put out 4 out of 5 Americans this summer said they feel anxiety about their finances, an increase of 9% since 2021, and 1/3 characterized their stress as moderate to severe. So I'm sure that's what a lot of you are feeling today. And that's one of the reasons Nick and I decided to really pivot over to this show to really a stress-free show. We're going to try to help you navigate through this chaos, through all this volatility, into some really stress-free, or what we call sleep well at night, or SWAN picks.
Yeah, that's the thing. I admit, Friday's an anxious day. If you weren't anxious on Friday, you're probably not human. Looking at my accounts, in unrealized losses, I lost a lot of money on Friday. Thankfully, I'm looking at my accounts now and I got it all back. So feeling pretty good about myself. But over the weekend, I had a lot of time to reflect on, am I holding what I should hold? I think times like this, a down 3% day kind of allows you to kind of realize, are you too overweight on something? Or do you not have enough bond exposure? Or do you wish you had some gold, et cetera, whatever it is. So to me, looking over my portfolio, I realized every single income producing investment that I had, I felt pretty good about, because that's my plan for retirement. I don't plan on selling shares in retirement to fund my lifestyle. I hope to just live off my dividends and never touch the principal, hand that off to my children, charity, et cetera. So those investments I still felt pretty good about. I do have a few non-dividend paying investments, maybe some more speculative bets that I did question over the weekend. So I may use this bounce back to lighten up on that. But I think the moral of the story here is I was not worried. I was sleeping well at night, but since the vast majority of my holdings do pay dividends, and not only do they pay dividends, they pay rising dividends. So I know that, year in and year out, my income stream will organically grow, regardless of what the S&P 500 is doing on a day-to-day basis.
Great. Well, I'm going to take a minute here just to remind our audience that we cover a very wide selection of stocks here at Wide Moat Research. And so what we're trying to do is provide as much diversity as possible. Many of you know me from Seeking Alpha, where I spent around 16 years covering a lot of real estate and investment trusts, as well as business development companies, BDCs, and MLPs. But today we're going to offer or provide you with a number of different picks. So Nick, we're going to start with you. You're not going to obviously talk about REITs today, I don't think. And then I'll touch on...
No REITs on my list.
All right, great. Well, then I'll touch on a couple of my sleep well at night or SWAN REITs. So, Nick, I'll let you kick it off here.
Sure, yeah. I certainly think there are sleep well at night REITs. I just knew that Brad would head down that road. So what I did, I went back to April, Liberation Day. The market fell 19%. We all know how that turned out. The trade war with China, et cetera, on Friday is what's sparking this sell-off. So I went back and looked at what did really well in April, because those are the types of things that will likely do well moving forward if tariffs get out of control again. I kind of broke it down into 6 categories here. We have defense contractors, the things that make bombs, planes, guns, etc. Utilities. No matter what the economy is doing, everybody needs electricity and everybody needs water. Domestic retailers, which really surprised me because you would assume with tariffs being put on China, all this kind of made in China, all the cheap stuff that they sell at Walmart or TJX, et cetera, that would hurt their margins. But those stocks did extraordinarily well back in April. So I was surprised to see that. That's not where I'm putting money in a trade war environment, but apparently a lot of other people disagree with me and the market favored those stocks. We have health insurance companies. If you get sick, you got to have insurance kind of no matter what the market does. We have service-based companies. These are companies that don't sell products. They're not really impacted by the tariffs. They sell services. So Uber or Netflix, things like that come to mind. We have factory automation stocks. Those are companies that benefit from, how do we fight the tariffs? How do Americans produce things at a similar price to a low cost of labor place like China, India, all the Far Eastern countries in general? It's by automation. Workers and unions certainly don't like to hear that, but that is how companies are going to adapt. So I like the companies that kind of help you build those advanced factories. And lastly, I talked about waste management last week, but trash companies, I'll mention that again. No matter what's happening in the economy, Americans are going to generate trash. We're going to have to throw away the trash. Somebody's going to have to take care of that for us. So those are the 6 or 7 categories that did really well back in April. So I think what I'd like to do is just highlight 1 or 2 stocks from each that I like today. All right. Well, in the defense contractors, I will say there's war happening all over the world right now. In Russia and Ukraine, obviously. It looks like we may have a peace deal in the Middle East, so that's great. The India and Pakistan, they're killing each other these days. There's the whole China, Taiwan, issue that could become something much more. So most of those stocks are pretty expensive right now. I think with all these kind of hot conflicts happening across the world, investors have bought into those stocks pretty heavily. But Lockheed Martin, I'll throw up a fast graph here. They're probably, I think, the cheapest. They're trading around 23 times blended, but they are expected to grow their earnings by 34% next year. So on a forward basis, they're not trading that bad. It's only about like 16, 17 times earnings. So I think they're my favorite defense contractor at the moment. They yield 2.6%. As you can see on the fast graph, they are trading well above their long-term historical average. However, in the last 5 years or so, they're sort of trading in line. So I think this company, when there's wars happening, it gets a premium. When it's peaceful times, investors kind of forget about it. There's plenty of wars happening. I think 16, 17 times forwards is a fair price to pay for a very high quality company like this. Lockheed Martin's been growing the dividends for decades. It's got a pretty high yield, 2.6%. The S&P only yields like 1.3% right now, I think. So roughly double the S&P's yield. Boring company. You do have to deal with like the national budget discussions if everybody kind of understands that the national debt's too big. Defense contractors, defense spending is always a place that politicians kind of on both sides of the aisle like to attack. The Defense Department is a pretty bloated budget. So if defense spending gets cut, obviously sentiment for Lockheed will not be great. But I still like this company better than like a Raytheon, an RTX, a General Dynamic, a Northrop Grumman. Those are all great companies. I own all of them. I don't own General Dynamic, but I own every other company I'm talking about in this industry today. But those ones are all really expensive. They're trading 20 plus times earnings. So I like Lockheed the best. Moving on to retail. I'm not buying retail at this valuation. Brad and I just did a video, I think 2 weeks ago, on our favorite retail plays, and I kind of bashed the Walmarts of the world for their valuations. This company's trading for 39.5 times earnings. It's growing its earnings at 4% this year. So to me, that just doesn't stack up. The PEG ratio is astronomical. Yes, it's a very high quality company. The sales are going to be there no matter what. So are the earnings. I just can't wrap my head around the valuation. So Walmart did very well back in April, kind of despite the tariff headwinds. I think people just assume they're too big to fail. They can negotiate. They have such big size and scale with their orders that they can really negotiate and kind of bully around these foreign suppliers in ways that most other retailers can't. So I suspect that's why Walmart did well, but I'm not a believer here. But if you like retail, just know Walmart did do pretty well back in April, and that could happen again if this trade war accelerates. Ross Stores and TJX, these are two discounted retailers as well. They're also expensive. TJX is 31 times earnings, and Ross is at 23 and a half. So I guess Ross is the best value of this kind of cohort of retail, kind of discounted retail, but 23 and a half for a company that's growing negative 2% this year. Ross is expected to grow 10% next year earnings, so that's okay. I guess 10%, 23, you're like not quite a one peg, but you're getting in that area, or a 2.0 peg, excuse me. You're nowhere near a one. 2.0 for high quality companies, okay. So looking at Ross, I guess that would be my pick in this industry, but personally, I'm happy to avoid it. Something that is interesting to me is the health insurers. Everybody knows United Healthcare. Their CEO was murdered. They had all these congressional investigations about their business practices. Are they fraudulently using accounting? There's all these issues with this company. However, over the last 20 years, there's very few companies in the entire stock market that have performed better than UNH from a total return standpoint and from a dividend growth standpoint. So Warren Buffett, I think, recently bought into this story on the sell-off. UNH is at like 350 now. At the bottom, I think it was close to 250. So it's already, ran up 30% from its lows, but it's still well off the highs. Before all this drama started happening, I'm looking at the chart here, this was a $600 stock. So there could be a lot of upside left. Earnings are expected to fall 42% this year as they restructure and as they look through their business to try to see where they can correct things. However, over the last 20 years, there's only been one other negative EPS growth year. So it doesn't get much more consistent than UNH. Analysts are expecting 7% growth next year and 18% EPS growth in 2027. So if you believe Wall Street, it won't be long before this company gets back to its double-digit growth trajectory. It's trading for less than 19 times earnings right now. On a forward basis, it's even cheaper. I think it's 17, 16 times. So UNH, I think, is interesting. 2.5% yield. For much of my career as an investor, this is like a 1.5%, 1% yielding stock. The massive sell-off we've seen has driven up the yield. So I find UNH interesting here. It is it's hard to predict. I hate investing in companies when there's like congressional investigations, when you don't know how regulation, what sort of impacts that could have, not only on the sentiment of the shares, but on the fundamentals that ultimately drive share price. So I don't own these shares, but I do think this is a cheap company. And like I said, no matter what's happening between the U.S. and China, Americans will need their health care. This industry has been proven it's too big to fail. President Trump's tried to change it. A few years ago, it was Jamie Dimon and Jeff Bezos and Warren Buffett. They got together. They said they were going to fix healthcare. They couldn't do it. If those three guys can't do it, maybe I'm cynical, but I'm under the impression that basically American healthcare system is not going to change. The companies like UNH that have been benefiting for years will continue to benefit. So I like this as a value play. If you like even bigger value in the spot, you have Cigna and Elevance Health. These are two smaller insurance companies, still pretty big market caps. Cigna is at 80 billion. They're both at 80 billion. So, but they're trading for about 10 to 11 times. So if you want a big discount relative to the S&P 500 and relative to these companies' long-term average price to earnings ratios, Cigna and Elevance are interesting insurance options as well. I'll throw up the fast graphs for both of those companies just to show how discounted those shares are. Moving on to the service companies. The two I'll talk about, Uber and Netflix, they do not pay dividends. They're not the type of companies we typically cover here at Wide Moat, but they offer very reliable growth. And like I said, they don't sell products. So there is no issue with tariffs. The world hasn't gotten around to tariffing services. That's something that they could do. I think Europe talked about that for a little bit back in April, and I think they realized that wasn't in their best interest. So right now, there are no tariffs on the services, and that bodes well for a company like Uber. They're expected to grow 21% next year. They're trading for 28 times right now. So expensive valuation, but 20% plus growth. For a long-term investor, I think that can make a lot of sense. Netflix is very expensive, 49 times earnings. However, there are a few companies that grow more consistently at a double-digit rate than Netflix. Very high margin, best in breed business model in the streaming space, A-rated balance sheet. They're going 32% this year, 23% next year, 22% the year after that, according to Wall Street consensus. So 49 times now, but if you have a 3 to 5 year time horizon on this investment, I think the fundamentals could certainly pan out in your favor. And last up, this is kind of the area of the market that I find the most compelling right now. It's these automation industrial stocks. Honeywell has long been one of my favorite industrial companies. They have the factory automation piece. They're conglomerates. They do a whole lot of things. But Honeywell even has a quantum computing piece that's pretty interesting from a long-term growth perspective. So you get quantum computing, you get factory, advanced factory automation, you get some of the boring stuff they do, like, home Wi-Fi and things like that. But, you get high single-digit growth, 7% this year, 8% the next 2 years, according to Wall Street, 19 times earnings, 2.4% dividend yield, very reliable dividend growth. So Honeywell is a pretty interesting stock here. As you can look at the fast graph, the shares have dipped throughout the last several months, and they're down at a pretty strong support level. This 19 times area has served as support throughout the last 8 years, all but 2 times during COVID and then once during 2019. So typically the stock bounces off this level. Obviously the past doesn't predict the future, but from a risk reward scenario, I do like Honeywell here. Rockwell Automation is a favorite. Here's a fast graph for that company. As you can see, it's quite expensive relative to its long-term average and relative to Honeywell. And Emerson Electric, once again, trading for 21 times. That's well above its like 18 and a half times area. So Emerson's a very high quality company. It has similar growth prospects to Honeywell, but it's a little bit more expensive, and the dividend yield is lower at 1.7%. So I like Rockwell, I like Emerson, but Honeywell is my favorite pick of the bunch. And then I'm not going to harp on these trash companies too much. Last week I talked about Waste Management. You can go look at that video there. But this company at 29 times earnings here, it's growing at 12-13% a year. So very easy company for me to own. Very reliable dividend growth. There's when I think about the world in 100 years, I can't imagine a society that doesn't produce waste. We're going to need companies to take away that waste and to dispose of it into landfills or whatever technology we develop in between now and then to get rid of trash. I'm sure that waste management will be a leader in the future as it is now. So this is just a perfect SWAN investment for me. 1.5% dividend yield. Dividend grows about 10% a year. So I like waste management, and I like Republic Services. Waste management is just cheaper. As you can see here, Republic's trading for 33 times versus Waste Management's 29 times. So Brad, those are my SWAN picks. I like all these companies. Most of them pay dividends. I think they're relatively isolated from trade war, hysteria. Sure, they might go down just like the rest of the market will, but their fundamentals, I think, will be unaffected. And as we know, over the long term, fundamentals are what dictate share price, not investor sentiment.
So, Nick, those are some great picks. I especially like the retail picks. And of course, to your point, there are a number of retail REITs and healthcare REITs that you can invest in today if you're not interested in the retailers. But it's great to see the performance of these retailers because those are the rent checks for those retail REITs. But
Yeah.
now yep. By the way, Nick, I was going to ask you, I should have said this earlier, but I got so excited with your shirt that you came out with today. But what happened this weekend for your football team?
Oh yeah, we won. Yeah, just so all the viewers know, when Brad and I entered into the meeting today for our recording, he asked me, what's the occasion? I think Brad assumed I might just wear tie-dye polos on the regular. So I don't. This is a special occasion shirt. But yeah, we won Friday homecoming game. We were up 30-0 at the end of the first quarter. So easy victory. Happy for our kids. Now looking forward to next week. The playoffs are still a possibility for us. So yeah, we just got to keep rolling.
All right, sounds good. Well, we're going to keep rolling here. Nick, great job with the first half. Now we're going to move into the second half. We're going to talk about some SWAN REITs, sleep well at night REITs. Now, last week we covered the tech stocks, which Nick mentioned earlier. And in that session, I talked about Equinix, which is a leading data center REIT with 272 properties in 36 countries around the globe. There's no need to go into the details here since I did it last week. You can go into the last week episode where we just talked about technology companies. However, I'm going to show you this fast graph below because shares are now trading at 21.4 times compared to their normal valuation of 24 times. So Equinix has generated positive earnings. You can see that on the chart every year since converting to a REIT. And I could see shares returning at least 20% over the next 12 months. So I just want to point out that pick here. We talked about that one last week in detail. Now, let's move on to the next SWAN pick, which is Equity Lifestyle, ticker ELS. This is a residential REIT that operates the highest quality portfolio of manufactured home communities, RVs, or recreational vehicle resorts, campgrounds, and marinas in North America. The portfolio contains 455 properties and 173,000 sites in 35 states and Canada. Makes this a very diversified REIT in terms of revenue and geography. Now, I'm launching a new REIT ETF soon called the Red State REIT ETF Index that will contain U.S. equity REITs with the highest exposure to the red states. Just want to point out here, ELS owns around 75% of its portfolio in the red states, which means it's likely to be a constituent in this new index. Now, here's a copy of a map. You can see the very broad diversification really throughout the country. The properties are located in retirement and vacation destinations with over 110 properties with either lake, river, or ocean frontage. Over 70% of the manufactured housing properties are age qualified or have a resident base with an average age of 55, which is a huge demand driver for this business model. Also, there's been limited manufactured housing development in the U.S. in the past 20 years, and this growing demand, coupled with almost no new supply, is a definite strategic advantage for this company. This is a map here showing the manufactured housing development. You can see that decline in development. So this is another wide moat advantage we see for ELS. Another advantage or SWAN attribute is the balance sheet. ELS has debt to enterprise value of just 20.9%. That's about as low as you get in the REIT space, with a debt to adjusted EBITDA ratio of 4.5 times. Also, 97% of the company's debt is fixed rate, and the weighted average interest rate is just 4%. In addition, ELS has grown its dividend by an average of 11.4% over the last decade, compared to 4% for the entire U.S. equity universe. So you can see this fast graph here. ELS has generated positive earnings in every year except 2010. Of course, that's coming out of the Great Recession. Analysts are forecasting 5% growth in 2026 and 2027. Shares are now trading at 24.0 times, slightly below the normal multiple of 25 times. So not a huge bargain, but definitely you see a slight margin of safety here. Dividend yield is 3.3%, well-covered payout ratio of 77%. Given this very modest discount I just mentioned and continued growth and dividend yield, I could see ELS returning somewhere around 15%, potentially 20% over the next 12 months as interest rates continue to decline. Now, the next one pick is going to be an interesting company that we talked about quite a bit here, Mid-America Apartment Communities. Again, this company is an apartment REIT. Much like Equity Lifestyle, they have outsized exposure in these red states, specifically in the Sun Belt. They're based in Nashville, and they have over 104,000 apartment communities located in markets like Dallas, Charlotte, Phoenix, Charleston, Savannah, Memphis, and even in Greenville, South Carolina, my hometown. Here's a copy of the map. You can see all the properties where they're located, again, mostly in these Sun Belt markets. They continue to capture positive in-migration trends as residents continue relocating from states like California, New York, Illinois, New Jersey, and Massachusetts. These demand fundamentals are expected to remain strong in 2025 for most of their markets. Also, they have an active development pipeline of 8 projects at a cost of around $1 billion. This active and completed development projects are expected to generate around $80 million in net operating income. That translates into total value creation of $260 million, or roughly $11 per share in FFO, or funds from operation. This is a copy of the development pipeline I'm showing you here. It shows the finished product as well as the projects that are underway now. Now, another SWAN attribute for Mid-America is the Fortress A-rated balance sheet. The company has a history of disciplined capital management with solid leverage metrics, including 28.9% total debt to total assets and 4.0 net debt to adjusted EBITDA. Now, as you can see on this fast graph, Mid-America has maintained consistent growth cycles. Although earnings or AFFO per share have declined by around 4% last year and roughly around 2% this year, analysts are forecasting positive growth in 26 for around 2% and then moving closer into norms of 5% in 2027. So the dividend yield today is 4.5%, which is well covered. And I could see Mid-America returning around 20% annually or over the next 12 months. Now, this is a copy of the fast graphs you can see here on the screen. I've checked all of the boxes, which are all the years which they have had positive earnings over time. And you can see that margin of safety as well. Now, Nick, I'm sure you know what my last SWAN REIT pick is going to be.
I have to say, I'm assuming Realty Income, and so maybe the first one that's not in this red state, because I do want to touch on that. Realty Income so diversified; they have all the states. Why do you like the red state? This is, I just want to make it clear, this isn't really a political thing. This is an economic thing. We've talked about this, the benefits of these kind of Sunbelt red states versus the coastal urban areas that are oftentimes blue areas. So can you touch upon that really quickly, why you like, the red state real estate as opposed to the blue state real estate right now?
It's pretty easy. I mean, I guess when you look at, and I mentioned the in-migration trends earlier when we were talking about Mid-America and the fact that a lot of people are relocating from the blue states to these red states that I mentioned. And of course, along the way, that brings more growth, more jobs, better real estate. So all of these demand drivers are really supportive of these migration trends into these places. It's not only just the individual demand from from the residential or consumer, but also it's the manufacturing and the reshoring and all those jobs that are going into those favorable markets that are not as regulated, frankly, as the blue states. And it also has to do. I mean, I'm living in one right now. Obviously, I'm in South Carolina. If you can't tell, and there's just a significant amount of growth here, and it comes down to we have very limited labor laws here. It's a very business friendly state, as is many of the red states. So I think that's really
And
the demand
taxes too,
driver.
right? I think that's a big part of it
Taxes,
too. I mean,
taxes, yeah,
yeah, 'cause I
taxes.
know
Just
you have property in West Palm, right? Is that, or you don't anymore? You used to live in West Palm, and I know we have a lot of colleagues that are leaving New York City and flying down to South Florida as fast as they can because of the tax benefits of that move.
yeah, a number of companies have relocated, not only to South Florida, but just all throughout the Sun Belt. So yeah. So anyway, I agree with you. I mean, it's not a political, although it just so happens that those jobs are really and those companies are really moving to those more attractive areas. So at any rate, so we're going to move on to, you're right, the last pick is Realty Income. Now, I talk about Realty Income a lot. The reason I decided to include it on the list, of course, it is what I consider to be the ultimate sleep well at night REIT. I was actually working on an article this weekend for Wide Moat Confidential, and I've got to keep this pick confidential for our members at Wide Moat Confidential, but it's really interesting because I think this company has a big real estate play. And if the company were acquired, if the real estate were acquired and split up into a propco opco, Realty Income would certainly be a beneficiary. And they're one of the few real estate investment trusts that could capitalize on this opportunity because of its size. And we'll talk about that here in just a minute. So the first advantage obviously is scale. Realty Income has over 15,500 properties. These are freestanding properties, which means they're typically four walls and they don't have neighbors. And they're in all 50 states in the UK and 7 other countries that are also in Europe. I've got a copy of the map. You can see all the diversification they have both in the US as well as outside of the US. Now, Realty Income is known as the monthly dividend company. They actually have the trademark for that, the monthly dividend company. And the company's mission is to deliver stockholders dependable monthly dividends that grow over time. Now, since its founding, Realty Income has declared 661 consecutive monthly dividends and is also a member of the S&P 500 Dividend Aristocrat Index for having increased that dividend for the last 30 consecutive years. The reason that I consider Realty Income an ultimate SWAN is because of the following wide moat attributes. Now, first, I mentioned scale. This 15,000 properties leased to 1,630 different customers or clients doing business in 91 different industries. So they're not just investing in one sector. They're all over 91 different industries or sectors that they operate in. So it's very, very diversified. I put a screenshot of the top 15 tenants. You can see companies like 7-Eleven, Dollar General, Walgreens, Dollar Tree, going on down the list. But what this chart really doesn't show you is this company is just not the largest company, but also that it supports the ability to execute these large transactions without creating outsized exposure to any particular client, industry, or geography. I mentioned this weekend I was working on this article for Wide Moat Confidential, and there's one company, again, I can't talk about it here, but they have the ability to bifurcate their real estate from their operations. And one potential buyer for this could be a Realty Income because they have that size advantage. One of the only few companies that can make those types of investments. And they've seen deals like this before with 7-Eleven. They did a $770 million 7-Eleven sell leaseback, or $950 million they invested in the Bellagio in Las Vegas. There aren't many REITs that can successfully execute this type of transaction. Now, the next key advantage of this monthly dividend company is the balance sheet. And I'll talk about this quite a bit, but that's a key to the dividend success for this company. They have an enviable A3, that's Moody's, or A- S&P rating with very strong credit metrics that include 99.9% unsecured debt and 5.5 times net debt to EBITDA. Now, a few weeks ago, the company priced a $400 million unsecured debt offering at 3.95%. Now, that had a February 2029 expiration, but they also priced $400 million at 4.5%. Again, this is unsecured. That's an A rating going to work. Those notes are due February 2033. So the blended weighted average yield of this for these particular notes, and again, not many REITs can do this, is 4.414%. So on the second quarter earnings call, the company announced in 2025, it increased its investment volume, its acquisition volume, to $5 billion. And the company also raised the lower end of AFFO guidance. So certainly signs are there. The company's going to be able to continue to grow. And again, the key thing here is with these rate cuts continuing, I know with all of this, I mentioned earlier, the jobs reports, tariffs, all this stress that everybody's seeing every day, what it's really telling me is that we have more rate cuts on the way, quite a few more rate cuts on the way. This is one of the companies that is going to be able to take advantage of these rate cuts and widen their cost of capital to deliver more dividends to investors. Currently, shares yield 5.6%. Again, as rates decline, the company will be able to generate this wider investment trails, which also means wider and more dividend growth. Shares now are trading, you can see the fast graph, shares are trading at 13.7 times compared with a normal valuation of 17.5 times. That illustrates the margin of safety you can see here on the screen. Now, based on the dividend, the discount and growth forecast, I believe Realty Income could generate 20% annualized returns. I also wanted to show you here on this chart, you can see this is how the companies perform with the peers over the last year to date, and also 2024, 2025, and so on. Now, year to date, Realty Income is up about 15%. Not the best in the group, but I believe that's going to continue to go forward. And frankly, the last several years have been very difficult, not only for REITs, but specifically in this net lease sector, because these companies really have been more like bonds. A lot of people don't understand the pricing power that exists for net lease REITs. And the pricing power is, yes, they do have rent increases, unlike bonds. Granted, they're modest increases, typically 1.5% to 2% increases per year, but also it's this fragmentation that we see within the net lease sector that is going to absorb and allow companies like Realty Income to continue to consolidate. Now, I want to show you one last chart, and this shows the size of the net lease REIT sector. As I mentioned earlier, Realty Income is the largest in the space with about $54 billion in market cap, which is about a third of that entire category. However, shares are cheaper than most of the peers, which I want to show you on this chart, and that exists because of the consolidation opportunity that we see going forward. We think the company deserves a much higher premium because of the size and the cost of capital advantage. So, Nick, those are the three I've got here today. I will say it's almost Halloween, and every year I've done this on Seeking Alpha for 16 years, so I'm not going to disappoint. I plan on doing two different shows here. One is going to be, Nick, you and I'll decide, but I'm going to do Trick or Treat, my favorite REITs. I don't know when we'll film it, but that's coming. And then also we're going to do Trick or Treat, the spookiest REITs. We're going to call out the companies that we think are the scariest and should be avoided. So we've got two of those coming. If any of those are interested in REITs, and Nick, I'm really anxious to get your portfolio, because last time we did your portfolio, a lot of our audience really enjoyed it. So we need to schedule that one too as well here over the next couple of weeks.
Yeah, happy to do that. Like all three of your picks. If somebody told me, Nick, you're only allowed to buy one company in the world and it cannot be a technology name, it would probably be Realty Income. I think I could sit back, collect that 5.5% monthly income, and just enjoy my life. So I like that as a SWAN pick. I like it. I like it as a value pick. And it's crazy to think that a company, such a defensive name could have, a realistic 20% upside on an annualized basis. But I think you're right. When you look at that 5.5% yield, when you look at low single digit growth, but primarily multiple expansion, which I think both of us expect to play out in the REIT sector at large, but especially with Realty Income, which is trading at a pretty, rare historical discount right now. So I like that pick a lot. And I look forward to the Halloween ones. I don't have a costume this year. I don't get to go trick-or-treating with my kids. We have a football game on that Friday night. So I may have to go to the Halloween store and get something for that, but also happy to do another portfolio review. Yeah, that's one of our highest watched videos here on the Wide Moat channel. The viewers spoke with their clicks. I'm always happy to be, as transparent as I'm allowed to be with my holdings. So I'm certainly happy to do another portfolio recap, and I'll kind of talk about what I've been doing in between the last video and this one as far as trading goes.
That sounds good. Well, thank you everyone for watching today. We look forward to seeing you next week. Nick, good luck next week. We're really rooting for you and your team, and we want to see you get to the playoffs.
Me too. Yeah. Hopefully we'll be back next week with an update. And until then, everyone, please sleep well at night and just, keep the long-term view. Don't, ignore the short-term volatility, and, keep your eye on your income.
Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy SWAN, sleep well at night investing.